Good morning, everyone. Welcome to this Fingal Chamber webinar. My name is David Branigan. I work with Fingal Chamber, and I'm delighted to be hosting this morning's event with our colleagues in New Ireland Assurance. The introduction of auto-enrolment in Ireland will place significant responsibility on employers and HR teams. However, this can be an opportunity to work with your advisor to shape a flexible pension plan that is not only compliant, but is also truly beneficial for employees. In this morning's webinar with Neville Maxwell and Claire Parsons from New Ireland, they'll share an overview of how auto-enrolment is expected to work, and they'll also discuss how it compares to other company pension plans and what solutions are available to help employers meet their needs. So with pension advice needed now more than ever, this event is ideally suited to employers here, particularly in the Fingal area. And whether or not you have a company pension plan or not, this is the place to find out all the information you need. So I'm delighted this morning to be joined by Neville Maxwell and Claire Parsons. We do have a Q&A function at the bottom of everyone's Zoom toolbar. If you'd like to ask any questions throughout, please do enter that in and we'll come back to those around the end of the presentation. But for now, I'd like to hand you over to Neville to kick off this morning's webinar.
Thanks, David. Morning, everybody. We're delighted to be here to talk to you about, as I said, as David has said, auto-enrolment and pensions and the changes that are there. So I'm just going to share my screen. And if you can just confirm that those slides are visible to everybody.
Yeah,
that's good.
They should be up. And I suppose what we wanted to just look at, if we put a little bit of context, rather than just talking about auto-enrolment or a master trust pension or corporate pension on its own, we actually want to talk about actually how best to reward your employees. So there's going to be a big spend that all employers will have to make over the coming years in terms of auto-enrolment. So we thought it's very, very prudent that you sit down, you understand fully about what auto-enrolment is as we currently see it and what the alternatives are to you. I've over 20 years experience in the pensions industry, meeting employers and clients and discussing various pension arrangements. So quite a lot of experience there. And obviously with all the recent legislative changes that have come through, we've been to the forefront in implementing that for a lot of our clients. I'm also joined by my colleague, Claire Parsons, who's a senior consultant with ourselves. I might ask Claire just to introduce yourself.
Yeah, good morning, everybody. Thanks, Neville. Well, my name is Claire, and I'm a pension consultant with New Ireland. And I suppose what I want to bring to the table today is just a little bit of practical experience, what I'm seeing out and about, meeting with employers, and maybe just to bring you through the experiences that I expect employers will be hit with or will encounter with the imminent launch of auto-enrolment and how best to deal with that. I deal directly with employers and I try to help them implement a pension scheme or arrangement that's most suitable to them and to their employees.
Okay, very good. So what I'll do is I'll just click through the slides here. And the first section I suppose we're going to go to is just an overview of auto-enrolment. So some of you might have been on different presentations. I know there's been a lot of discussions, presentations from different organizations over the last 6 months. But I suppose what we want to do here is just give you a quick understanding of it. So as an overview, it's going to be a retirement savings scheme that all employees will be scheduled to be introduced to in 2025. Okay, so the minister came out a number of months ago and said it is going ahead. And there has been quite a bit of progress in terms of the bill that has been proposed, recommendations that have been made to it. So it is progressing through the House of the Oireachtas, and now it's at that phase where they have to actually build it and implement it. So very quickly on the left-hand side, members will automatically, or employees will be automatically enrolled into the government scheme if they do not have a pension scheme, if they earn more than 20,000 per year and they're aged between 23 and 60. So pretty simple and straightforward. Three main kind of data points that will clarify whether someone should be in an auto-enrolled pension scheme or not through the government. Employees actually can voluntarily enroll, right, if they don't have a pension scheme, if they earn less than 20 and they're inside that bracket. So we have compulsory on the left, voluntary on the right. I suppose the most important thing here is employers will, for the first time, be required to make pension contributions. So I know Claire is going to talk about this in detail later, but this is a budgeting issue that all employers need to take cognizance of and plan for into the future. What does it look like in terms of the contribution structure? And again, we won't comment on whether it's good or bad, but at the moment, what we have is it's going to be calculated on an employee's gross earnings up to 80,000 a year. So not just basic salary, all earnings that an employee makes up to a cap of 80,000 per year. There isn't tax relief available to employees, but the government will do a top up of €1 for every €3 paid in by an employee. So if we look at it, if it gets launched in January of next year, in the first 3 years, each employee, employer, and government will make contribution of 1.5% of gross income, and the government will top that up at 0.5%. So a total contribution going in there of 3.5%. When we get into years 4 to 6, 7 to 9, and at year 10, what we'll see in the Irish market is, and just to give you an example, let's say it launched in January 2026, 10 years later, every employee going into a pension scheme in Ireland under the government auto-enrolment system will have to make a contribution of 6% of their gross earnings. The employer will have to make 6%, and the government make 2%, so that's 14%. So this, in effect, is going to create a very good thing in terms of people will be in a pension scheme, which we know is important that everyone has because it prepares them for the future when they come to retirement. But the base rate, the base type of contribution that'll be going in for everyone in the country will effectively be 6 and 6. So we've seen this in different jurisdictions, be it in the UK and Australia. And what we've seen is that it's seen as a real positive by employees, but it's certainly something that employers need to be aware of and need to prepare for and see actually does this suit them. So that's what we see it as at the present. This little picture is a little bit busy, but I'm going to give you an understanding, and this is from the Department of Social Welfare's own documentation. So we have the Central Processing Authority here in the middle. This is going to be the government body. It's now going to be called NERSA, and that'll be the central processing body for all pension schemes in the country. Effectively, how they'll figure out whether someone needs to be in a pension scheme or not, they will look at the revenue details of every employer. So when you make a submission every quarter, if employees, excuse me, don't appear on that as having pension contributions, that data through payroll will be communicated to the employer. They need to then get their employee to go in and register into the government system. Once they do that in the government system through an employee portal, that will communicate back into employees, into the Central Processing Authority to start making contributions and collections. So it's a kind of a checks and balances system done every quarter. So it's a layering of information that they get in. Assets then will be transferred over to different fund managers, and effectively it's kind of a circular process. That system hasn't been built yet, so that's why I would say that the launch date of January is a little bit optimistic. But I suppose the reality of it is this is something that is going to happen. So employers have a lot of time to prepare for it and decide what they want to do. So,
Neville,
yeah.
can I just ask on that, just from, I suppose, from a member's perspective and an employer's perspective, is there potential shortfall here? You know, the way the government is going to do this sweep every quarter, kind of a catch-all. And if, you know, for example, someone has joined in the meantime their employer's scheme, and there's a double deduction, there's potential for kind of payroll difficulties there.
Yeah, it's something that, yeah, I think that's a good point, Claire. It's something that I know we've been at a lot of meetings with the Irish Association of Pension Funds, with payroll providers. There is a gap there, and there is clarity needed on not only that, but on a number of other issues that we can see within the current proposal as is. So it's going to be a little bit difficult to manage. Payroll is going to be obviously key to this. In terms of how that's structured and how they capture people to be in the scheme, but also anyone in that period where they've opted into a normal employer plan and they're not they don't need to go into the government arrangement. So there is, as we know, the most important aspect to this is actually your own payroll provider being able to speak to the government system, being able to then remit contributions, etc. So there's a lot of work that has to be done there to make this right. And payroll is the most important aspect of a business, because if it's wrong, then people have a difficulty, and it leads to issues for HR managers. So what you have here is an overview of how it's proposed to work, but operationally, I think we need to get it right. So maybe what I might do is hand over to Claire, who's going to go through, I suppose, what a master trust is in terms of what we see most employers in the Irish market now implementing from a pension scheme perspective.
Perfect. Thank you, Neville. Yeah, so a master trust, it's simple enough in one sense. It's an occupational pension scheme where multiple employers essentially feed into one large single employer trust. And I suppose what it does, it's really economies of scale across various different headings. So the structure will allow employers to benefit from shared governance, which is hugely important. And I think that's why, with IORP's 2 requirements, it's too onerous, and costs as well, shared costs. Running a single employer trust is virtually impossible for a smaller employer because of the costs. So under a master trust, at least they're shared, and everything is combined. And then you've got the benefit of professional management under the master trust itself. It is designed to reduce the administrative burdens and enhance compliance with regulatory requirements. And I suppose what we have is a set of number of employers on one side feeding into the New Ireland Master Trust in this case. And then the administration system is our digital platform that is the admin system for the actual master trust arrangement. And that is the member, advisor, and the employer portal. It's a one-stop shop, and everything is held there within the digital platform, My Pension 365. So I suppose just to move on and to have a look and kind of, get under the bonnet here and have a look at C under various different headings, auto-enrolment versus master trust. And I'm going to try and kind of have a more practical view on this. We know from, I suppose we have an idea of what way a private pension scheme works. There's flexibility from a contributions perspective, but under auto-enrolment, it's fairly rigid. It's fixed criteria, and there isn't an option for additional voluntary contributions. Once-off contributions aren't allowed either under auto-enrolment, but there would be full flexibility under a master trust arrangement. The difficulty I see here is, from talking to HR managers and financial controllers, there are a number of concerns around contributions and how they're calculated, because under the master trust, the calculation is basic salary, but under auto-enrolment, it's gross salary. And that can cause quite, a couple of unknowns. The most of, I think, from a budgeting perspective, it can be difficult because you're calculating auto-enrolment pension contributions based on an employee's gross salary. That's capped at 80,000. With the master trust, the employer has a little bit more control because they will determine the definition of salary when they're setting the scheme up. And then essentially, the control is there in relation to the related costs of the pension contributions, because the contributions are a percentage of the basic salary. And that's the way most master trust schemes would operate under basic salary. I actually have a client where a large portion of its workforce is on a relatively low basic salary. They have a significant overtime shift allowance, and the differential in their basic pay versus their gross pay can be up to 30 to 40%. So if you're to look at this as an example from a budget forecasting perspective, it'd be very difficult to see, the actual potential costs if you're looking at gross salary. That client has a master trust pension scheme in place, but if they were to look at AE, their costs could, for a lot of their employees, their costs could go up, and it's more that they can't actually tell what the cost would be because it's based on overtime. And that results in a significant unknown for the employer, which is not a nice scenario for them to be in. But it's much easier under a master trust arrangement to forecast the costs. From an employee's perspective, Neville has touched on the contribution rates. We know that it starts off with 1.5% for the first couple of years, and then potentially up to 6% after year 10. But there is a max salary cap of 80,000, and that may be restricted for people on higher salaries. And then there's the lack of flexibility to pay more ABCs when so they wish, and as I said, no once-off contributions. And I think really from a rewards perspective, HR and rewards managers are concerned in certain scenarios where they might have employees that will, are started pension funding later in life and they're trying to make up for lost time, or, especially women in the workforce, they may have been on reduced hours or taking career breaks to raise their families, step back into work, and they need to bump up their pensions through ABCs. That facility is not there under auto-enrolment. Smaller employers then are also concerned because I suppose it's just that whole, payroll piece with gross earnings under AE versus basic salary under the master trust. If you have a one-man show where you've got, one person running the payroll, it can be difficult just to get their heads around the different concepts and the different calculations. From a tax perspective, again, I suppose what we're here to do is kind of highlight the differences and draw your own conclusions. There's no tax relief available under auto-enrolment under the employee contributions. It may benefit lower taxpayers, and we could see that really for higher taxpayers, they would be worse off. For a master trust contributor, an employee will get their margin rate of tax, so it'll be 20 or 40% tax relief, which will be available to the net pay system. So even from a cash flow perspective, from a member's perspective, it's always coming off less tax. So from cash flow, it may be easier to manage as well. Then, I suppose really what an employer has to do is they'd have to determine and analyse their workforce to determine, the categories of employees they have and to see what best fits their actual payroll of their actual employees. Moving on to retirement age, the auto-enrolment system, it's fairly structured. Again, it ties in with state pension at 66. And we don't really have clarity in relation to, the retirement options. We have a fair idea. We don't have exact science as to how you draw down your benefits yet. Ill health, early retirement, again, further clarification is required. There's certain things we don't know the ins and outs of yet. Under master trust, normal pension rules will apply. Members will have the benefit of being able to early retire from age 50. And in any event, if they're retired due to ill health, age doesn't really come into it. So there's a lot there. And I suppose, for certain things, there's a little bit more clarity that is actually required. But we do see, certain concerns amongst employers when we're kind of analysing under those various different headings.
Okay, and I suppose, Claire, from again your conversations with employers, say if I look at those three, what's the biggest concern that they have within those set of comparisons?
I would think cost, because I just think the unknown for financial controllers is, they like to budget and they like to know what's around the corner. And I think when you're looking at basic versus gross salary, there is an unknown there, and there's a lack of control and a lack of they can't foretell. That's the difficulty. Okay. If it's basic salary, it's defined, it's done and dusted. They know what to expect.
Yeah, and so from a business perspective, it's uncertainty versus clarity.
Yeah, exactly.
Okay, very good. So if we look at the next set of criteria that we're doing a comparison on, you have 4 listed.
So there. Perfect. So we'll break it down into risk, benefits, fund choice, advice, and charges. Under auto-enrolment, you can't actually add on risk benefits, but you can do under a master trust, and I suppose when you're taking kind of more, holistic approach, employers like to offer a death and service, and it's easier when you can have it all as part of the bundle. The service is part of it, often offered as part of an employee contract. So you'll have a pension maybe referred to, and you'll also have death and service. Fund choice, I think, is it's limited under auto-enrolment. We know there are 4 funds available. There'll be a target dated strategy, and there'll be 3 risk rated funds available. No member selection investment manager. Whereas if you're comparing this then to your master trust, there's a suite of funds available. And within the suite of funds, there will be, a number of funds in each of the different risk categories. So you're kind of covering off on everybody's needs, going from the lower risk to the higher risk. And also it would include the target date strategy, which is, a lifestyle strategy in the New Ireland suite. So it just means from a member's perspective that they can marry their investment strategy with their potential retirement strategy. So we can look and see, if somebody wants to draw down in ARF versus taking tax-free lump sum versus taking annuity, the target date strategy will work, and it can be tweaked, exactly as per the member's potential wishes. And also we're finding that people are looking for, the ESG investment, the funds, 40% of the New Ireland funds are Article 8 compliant, and the passive Irish is moving into that space very, very shortly. So, that's what we find employers are looking for because their members are looking for it. And we feel we tick that box from that perspective. We also feel, I think it's important from members' perspective that they're not, they're not pushed into any particular fund. They can spread across the various different funds. And if they didn't want to go 100% with the default strategy, they can pick and choose portion of their fund or their investment strategy in the default and maybe put their, ABCs or employer money into one of the other funds or a number of the other funds. Up to 13 different funds are available. So flexibility we would see as key, so that, they can fund appropriately, invest appropriately, and then draw down in line with their investment strategies when it comes to retirement. Just moving on to advice. Well, this is the interesting thing, because really there's no advice under auto-enrolment, and I think employers are a little bit at a loss there because they know there is nothing included. But still, employees are going to want to know about auto-enrolment and what there'd be a general communication from the government. But I think once someone joins auto-enrolment, they're on their own pretty much. Whereas under a master trust, both employers and employees are provided with advice from day one, all through the journey to retirement. And, professional and qualified advice is part of the service. And that's hugely important. I think really from an employer's perspective as well, as things change, to know that you have a professional there to bounce things off, to make sure that your pension scheme is fit for purpose. And also from a member's perspective, that they know that they have access to a qualified advisor to help them on that retirement journey. So I think advice is key from that perspective. That's why we would look at it. It's a pension. It's not necessarily, trying to sell pensions an off-the-shelf product. A lot of advice is needed. This is someone's pot of money they've worked hard for. It's important to get the right advice to make sure they manage it appropriately. Just moving on to charges. We don't really have clarity. We know that there's talk about 0.5%. We don't know what's included in that really. We need clarity on it. Whereas if you're going on a master trust, it's negotiated between the employer, the advisor, and the provider to cover the range of services that the employer wants from their advisor. So it's a negotiation, and I suppose if you want advice, it can be paid for within the actual overall master trust.
Okay, so there's quite a lot there, Claire. I think what I'm taking away from that is under auto-enrolment, there's would I be right in saying that advice is going to be needed for any employer? And that's what we're seeing occur in the marketplace at the moment. But under an auto-enrolment, there doesn't seem to be any. A government website, maybe?
Yeah, that's, I think, what Tim Duggan has said from the department. There's no problem there because we are going to give the advice, but it's up to Mr. Employer to navigate the auto-enrolment system independently. And they're concerned. They're concerned about will there be adequate guidance so that they can fulfil their responsibilities as an employer. From an employer's perspective, a pension is very significant, and it's significant spend for them as well. So, it is crucial that they get, the sufficient support and the resources available to ensure they're comfortable with their offering. We would think that access to advice and clear guidance and clear guidelines are required. It's to navigate through this. It's very complicated. We've gone back and forth. We're pensions professionals, and we've gone back and forth on this over the last, kind of 24 months to 12 months, and we still have a lot of questions. So, it's quite obvious that employers do too, and I think it's quite daunting when they're going it alone on an auto-enrolment route. Yeah,
exactly. If I suppose you're at the coalface of dealing with employers as our own advisors in New Ireland and across the market. I suppose, what are they doing in 2024?
Yeah, so they're looking at what they have. So they're looking at their existing schemes, and they need to ensure that that aligns with what is required from a regulatory perspective. So a lot of people are now making their scheme compulsory for all existing employees where they can do, and then they'll amend the eligibility rules for compulsory for new hires, and they'll amend the eligibility for existing employees. And for some employers, for large employers, that can be difficult because you're talking about contracts of employment, and it is a lot of work. For smaller employers, that is definitely the route they are taking. They're just kind of, taking the bull by the horns now and just making themselves auto-enrolment ready, in the sense that if they bring everybody into their pension scheme now, they don't have to worry about having to have deductions going to auto-enrolment. But they are looking at the market, and they are kind of trying to find the most suitable and competitive schemes out there. And it's interesting because, what we've seen change over the years with regards to what is important to them and what they need to take into account when they're looking at, the best fit for purpose scheme. What they're looking at is member engagement, the costs, the technology, and investments is interesting enough, is a last. So really what people want to do, employers want, is they want to make sure that their employees are engaged, and they've access to information in a timely manner. And of course, from an employer's perspective, costs are important as well.
Yeah. So I suppose what just to get out of that, I suppose what I'm hearing is that employers don't want to run a normal pension scheme and an auto-enrolment scheme at the same time, because it's administratively quite heavy and difficult potentially. But they're also going and looking at their existing providers, for want of another word, and saying, look, is it actually going to deliver for us into the future? The needs of members, our expectation as members of pension schemes. That's the driver, the key driver. Legislation, as well as, I suppose, if employers are making a big spend, they want it to be appreciated by the employees. Would that be fair to say?
Exactly. I think we're seeing that, as the months go by, when we look at, and I know you'll touch on this, Neville, as well, when we look at engagement and member engagement, employers want feedback on this and what's happening. They want their employees to know that this spend that they are making is a part of their rewards package. And I think it's to do with, the overall financial well-being. It's the whole package, and employers want to be appreciated for that as well.
Yeah. Yeah, it's a big spend, so it's getting value for money. I suppose what I'm going to talk about now, if we take both of those aspects into account, auto-enrolment and what a master trust is, or a corporate pension, as it was traditionally known as, I'm going to just touch on the New Ireland Master Trust solution. We brought this to the Irish market about 2 years ago. We partnered with a company called Smart Pensions in the UK. They were working in the corporate pension market over there with what we would call a digital experience, digital type platform that was based on auto-enrolment. So the UK market is quite ahead of us in that sense. And what we looked at was, well, service, experience, as you mentioned, Claire, the service of an employer, but also the experience that an employee has. And I suppose we looked at a number of key aspects to this. For example, like setting up a company pension scheme. I know on our platform, you can see the comparison between the market versus ourselves, less than 4 days. Onboarding members was a new thing that we brought to the market. Instead of filling out your traditional paper application forms, it's an online upload. Members receive their invitation, but they also receive their documentation immediately. So a huge difference, I think, for employers to experience that, and has been I suppose from our perspective, a big benefit to us in growing our client base within New Ireland. Simple things like fund switching, it's all done automatically. And probably one of the most important things in my experience of dealing with employers is cash allocation. So when an employer makes contributions into a pension scheme, a bit like banking, you want to be able to see that it's being charged and applied to the relevant accounts. And that's what the My Pension 365 digital platform actually does. So we're trying to tick a lot of the boxes and future-proof what is there for clients and members going forward. Just to give an overview of that, the New Ireland has over 1,300 clients now operating within our own master trust. We provide outsourced services for a number of different employers, but we've nearly 53,000 employees using this type of system. So it's come down to two aspects, I suppose: the review of the market that Claire mentioned earlier on that's going on. Employers looking for a better experience, because ultimately it's about service, but then it's about actually that member experience. And we do feel that service is key. So as I mentioned earlier on, we set up the plan quite easily over an online system. You onboard your employees digitally, so no more paper, no more email traffic back and forth. Everyone gets their their documentation into their email address. Automatic payroll validation. And then an aspect which is new to the Irish market, we use a system called Intercom to analyze and review all the communication engagement that goes on with employees. So being able to target employees with information. So as an example, I think, Claire, you mentioned women in pensions earlier on. We recently conducted a campaign where we communicated to women to let them know that they need to review their pension scheme, they need to analyze it, but we were able to target it directly to them. So it's helping employers actually communicate. And in fairness, the system that we're using is actually awarded last year within the Irish Pensions Award as the leading communication provider within the Irish market. So it's delivering to what employers actually need. I think for members, ultimately, it's about actually giving them instant access, putting them in control. I think you mentioned earlier on the need for a pension is paramount. Okay, we all get to retirement, and the question often people ask is, if only I had known, if only I was aware of what I could have done. By moving it to a digital type system where they have access to everything, a bit like online banking, people can see things, become aware of it, and actually engage with it and make informed decisions. So we're trying to empower people, and we see this from our platform. We see that people are engaging, they're taking cognizance of where they're at, and then they're actually going and looking for advice. So as well as being able to transact and look for information, they can then deal with their broker or their own New Ireland advisor to get information on their pension scheme and implement stuff. And an advisor is so important. So not only do you use digital, but you have to use what I would call there's kind of a number of key areas. So when people are joining, they need to have that engagement, but they also need to know, are they on track? So as well as being able to use online, they have someone there to talk to. So this is what an employer would provide through an advisor system. Whereas if we think back on auto-enrolment, we're in a situation there where employees effectively will have to link in with a government body, government organization, an online portal, I assume, that'll answer their questions or not. So in our experience, what we're seeing is member-focused advice, employer-focused advice with an advisor, but having a digital platform there to help is a key benefit.
Neville, can I just ask there just quickly,
Yeah.
just from the interactions perspective on the portal, what's the feedback been, from some of the comms or the member comms, whether it's verbal or analytical, what are we hearing?
Yeah, so I suppose from the comms to members, what we're seeing are communications to members, the engagement to members. We're seeing very high open rates or hit rates in excess of 60% for everything that we've done, which the industry average in the UK and Ireland is about 25 to 30. So we're sending out informed information, informed messages, education to people, which is what we want. I think many people have been in pension schemes where they're putting in a lot of money. We know they don't look at it because they get a paper statement once a year, which they file away and don't look at it again. Whereas if it's on your phone, if it's on your laptop, and you can get in and see it, people are beginning to take ownership. So that's going to be so important. So having the advice there, that knowing that, well, I have a state pension because I've worked, plus I have my private pension. It helps them on that journey to retirement, knowing that there's something that's going to be there for them. But we've also ensured that the type of communication we're making is relevant. A 20-year-old won't be receiving the same type of engagement or communication as someone who's 60. So it's important that we actually do that right. And as I said, it's won awards for the type of communication we're doing. So we're certainly building on that. So I suppose what next? What we're seeing is that all employers need to make an informed choice for your business, for your employees. We know that auto-enrolment would mean employers must contribute to a pension plan. The date that we've been given is January 2025. I think we've said it's going to be a little bit tricky for it to be implemented, but it is going to come down the track. So, Claire, I suppose from your perspective, what do employers need to do?
Well, they need to look at what they have now, and they need to future-proof it and make the changes, and not wait for it, I suppose, not wait for to be forced to do it. And I just actually see a question coming in there, but it's literally, what does an employer need to do to future-proof? But it's have a look now, see what you can do, make your scheme auto-enrolment ready, and that's it. It's take action and not wait.
Yeah,
get it.
Yeah.
Guys.
Yeah, let's not be typical Irish and leave it to the last minute. It's a panic. So, and actually make a choice. Do you want to use a government system? Do you want to use auto-enrollment when it does come out in whatever format it is, or do you want to have control? That's going to be key. And advice is certainly something that we're seeing more and more employers do. I think at this point, it'd be good if we open up to questions. I know there's some there, but I might stop sharing in the next few minutes. I think there's a couple of there. We have one there from Debbie, if we can answer it. For new employees, will they have to be entered into the scheme immediately or when they've passed their probation? Currently, we have a group pension scheme, and once the employee passes their probation, they're invited to join. So the answer to that, Debbie Tracy, is that under auto-enrollment, you will be swept in immediately. Okay, so what we're seeing a lot of employers do for employees is actually get rid of the probationary period. So effectively, they're inviting them to join the pension scheme from day one. Okay, so that avoids them getting caught in the sweep. But what employers are then doing is they're still keeping the 2-year vesting period, which means that the assets from an employer perspective are owned by the employer for those 2-year period if employees actually leave. So it's a discussion that we're having with more and more employers, and we're happy to go through it. Gary came in. Will the slides be shared afterwards? Absolutely, Gary. Yeah, we'll have them there. Audrey Dolan came in. What is the employer's contribution to a master trust? Audrey, it can be whatever the employer wants. So you design your own pension scheme to suit what you want to do as an employer. So let's think about what we're trying to do here. As an employer, you want to reward your employees. Okay, you want to reward your existing employees and you want to attract in other ones. So you design a pension scheme that suits your industry. So if you're working if it's the IT industry, construction, retail, what we're seeing a lot of employers actually do is turn around and say, well, I need to match what's happening in the market to attract employees. So that's information that we can bring to clients. I think, Claire, you've seen that quite a bit, haven't you, in the sectors that you're working in?
Yeah, absolutely. And like, even it's that, if I'm making compulsory now rather than the 6-month wait, will I go with the auto-enrollment structure for the first 6 months? That's a decision for the employer to make. There's no right or wrong. Sometimes it's just better because, as you said, Neville, we're going to apply the 2-year vesting, so the ownership doesn't kick in anyway. That we'd often say, well, just go with the simple structure and go with, the normal structure you have in place. But you can have a tiered structure and have a lesser contribution for maybe like the first 6 months, if that's what the employer wants to do. It's not an issue. You can have various different member groups. We don't know. What we do know is that we know that the auto-enrollment, we know that's set out. There's nothing at the moment to say that a master trust has to mirror that in any way. It's not there. It's not a requirement. So it's what works for you and your costs.
Exactly. So it's from an employer perspective, they have that control to almost bespoke their own pension scheme to suit their business. I'm just checking to see if we have any other questions in there. Aideen Troy, temporary employees, so for busy periods over Christmas, are they to be included under auto-enrollment? It's a very interesting question, Aideen. And this is part of the lack of clarity, I suppose, the vagueness that we have. Questions have been raised with the authority. So, for example, if you have someone in there at Christmas time, say they're in for the month of December, and they earn, say, €3,000 for that month, will that trigger them to be eligible for auto-enrollment? Because if you multiply 3 by 12, you're getting in excess of €20,000. So potentially that could trigger them to be subject to auto-enrollment, and it kind of creates a little bit of a loop that we know isn't real. We know they're only going to be in for a month. So there'll be an opt-out option, I think, there for employees to say, look, I'm only working for a month. But again, it's a little bit of uncertainty. And again, we're waiting for more clarity on that kind of stuff. But certainly, yeah, those temporary workers, when they fall within the category, that there's a worry there. Obviously, if they're under 23, they don't have to be auto-enrolled. But again, what we're really, I think the most important thing here is to look at your existing pension scheme. See, are you happy with it in terms of how it's structured? The administration of it, the processing of everything in the background. Are your employees happy with it, about the level of engagement they get? And is that fit for what you want to do? You're spending a lot of money on it. You're making contributions already, I'm sure. So you want to actually make sure you're getting value for money and it's appreciated, because it is a big benefit that employees expect. Having, I think what I've seen, Claire, is our meetings that we've had with employers is HR are saying, look, I'm spending this money. I want it to be valued.
That's it, exactly. Yeah, to have an understanding of it and to understand the importance of it, and that it is a reward for employees, and that's the way it has to be looked at.
Yeah. Okay, so I'm just conscious of time. I think we might have one more question
One more
there.
question.
Sorry.
Yeah.
That's Gary. You might take this one, Claire.
Yeah. I have a similar question to the last one. What about employees with multiple employers who may or may not meet the 20,000 threshold? How would an employer know this? Is that calculated on a pro rata base quarterly? It would be down to the person's, it's their record, their PPS. So I think it would be, it would all be looked at together with my understanding of it, Neville. I think it's all down to the member record across multiple employers.
Yeah, and again, there's a bit of uncertainty there, Gary, in terms of how it actually be processed. If you think about it, you could have 10 grand in one location, 15 in another, et cetera, et cetera. Who's responsible for the remittance? So again, there's clarity needed on that from the authority. Not so much in terms of the bill, but actually how it'll be processed. Our big thing here is we need to actually make sure that operationally an employer can actually process the pension contributions and know what they have to pay. And at the moment, auto-enrolment is uncertain for all of us
I think
operationally.
I think Neville, at the outset when you said that the build, the digital build is ongoing now, like that's the part. This has to work. So it it has to be work. It has to be developed. The software, it has to be implemented, and then we have to see how it pans out. And that is my biggest kind of, I suppose my biggest concern really is in relation to these deductions and how is that going to work. If someone's personal situation changes, how quickly does that auto-enrollment system feed back into inertia? How does that actually work from a practical perspective? Because we do know from looking after pension schemes, the biggest headache for people is really remittance of contributions or deductions from salary. That's what it is. That's what people are concerned about. It's their pay. And employers are concerned about remittance of contributions. So it'd be interesting to see, but I know that there are a certain number of uncertainties from that perspective still.
Yeah. Advice is key, I suppose, David, would be our message. So I think we've just hit our time. So
yeah, fantastic. Thank you so much for providing us with all that information. I suppose as much as we possibly know now, it sounds like we'll probably need to do a refresher session nearer to January when this is supposed to be launching. You mentioned that might be optimistic, but I think hopefully we get more clarity on some of the questions that the audience have asked there this morning by that stage. We will, as mentioned, share the slides from this morning's presentation and recording of it for anyone who wishes to watch it back or to share it with colleagues. So hopefully that will be helpful to more people that were interested in today's event. So again, thank you very much to Neville Maxwell and to Claire Parsons for your presentation and also for answering the questions from within the chamber here today. We will share out your contact details afterwards. So if anyone has any follow-up questions or wants to get in contact with the New Ireland team, they'll be able to as well. So thank you very much for participating this morning and for all your time and efforts. Thank you again.
Thank you, everybody. Thank you, David.